One of the street's top technicians among them. He's Jonathan Krinsky, BTIG. He joins us now. You put out a note today, quote, "The memes are back in town. New ETF launch has shades of late 21. Tell us more."
Yeah, hey, Scott. So, 21 was the initial meme frenzy with GameStop and AMC in early 2021, but it wasn't until December 8th, 2021, when it actually got around to launching a meme ETF where you could invest in the so-called meme stocks in an ETF form. So at that point, that's right about when the NASDAQ itself was topping before its bear market. Then fast forward to November of 2023, the meme index at that point was down about 80% from when the ETF launched, and the ETF actually closed. And so I think the performance kind of spoke for itself. And since then, the meme index has come roaring back up about 100%. And today, actually, the meme ETF launched again, started trading. So it's a different number of stocks, different type of stocks, a lot of quantum computing. But the sentiment is still there, and oftentimes these ETF launches and closures can kind of mark turning points and kind of give you a good gauge of sentiment.
Do you want to, speaking of, weigh in on the idea of froth and excess in the market and what certain charts may be telling you?
Yeah, I mean, so it's more of the same, really. We have this dispersion, massive dispersion under the surface, where a lot of the meme and retail favorite stocks and AI stocks have been doing quite well. Some of them are probably a bit extended for our liking. And then on the other side of the coin, you have a lot of the real economy. I mean, take a look at the restaurant index, which is hitting almost as low as it was in April. And then you have to really look at some relative performance. You can't always tell an absolute performance, but look at the relative performance of the airlines, hotels, home builders. You go down the list of a lot of the consumer-facing parts of the market, and then not to mention some of the credit-sensitive parts of the market, like private equity and some of the business development companies. So there's just a lot of dispersion under the surface, and I think it speaks to the fact that the actual consumer might not be doing as good as the market says, but that doesn't mean the overall market necessarily is at a top.
I'm betting you're looking at a lot of gold charts these days, like everybody else is, trying to figure out what they're saying about where it's going. I think the prevailing thought seems to be it's going higher. It was above 4,000 yesterday, first time ever, only extending it today. What do you think?
Yeah, so gold's a tough one for us because we are believers in the long-term secular trend that's been in place for quite some time. But there's periods within that you want to be a bit cautious, and you get, maybe not the best time to buy. We think now is one of those times for a couple of reasons. One, gold itself is about 26% above its 200-day moving average. That spread is about as wide as it's been over the last 15 years. And all 5 prior times when you got to that spread saw either meaningful pullbacks or at least a pause. Most recently it was in April of this year when we saw about a 4 or 5 month consolidation. We also have extreme volume today on the GLD ETF. It's going to be the highest since April. And gold tends to see extreme volume on the upside, unlike equities, which see volume at market bottom. So there's a lot of reasons to be a bit cautious. Again, I don't think it's the final high. I think the trend is still firmly in place, but there's going to be probably better entry points in the months ahead.